Welcome back. In this second learning outcome, we move from definitions to the real world, looking at what has powered globalization over the past half-century and how it has reshaped the UK economy. This outcome really comes in two halves. First, we'll unpack the key forces that have driven globalization forward over the last 50 years. And then we'll weigh up its impact on the UK from several different angles. Throughout, we'll keep coming back to real British examples, from the car industry to Jaguar Land Rover and the story of offshoring. So what has actually pushed globalisation along so quickly? It isn't any single cause, but a handful of forces reinforcing one another. The growth of multinationals, leaps in technology and containerised shipping, and the steady lowering of trade barriers by bodies like the WTO. Think of them less as separate levers and more as gears that turn together. No one factor tells the whole story. The first driver is the sheer growth of multinational companies since the 1970s. Chasing lower costs, new customers, and raw materials, these firms have spread their production right across the globe. By placing each stage wherever it's cheapest, they build long international supply chains and pump up world trade, while their investment carries capital and know-how between countries. A firm like Samsung, sourcing and selling on every continent, is both a cause of globalization and a product of it. The second driver is technology, which has slashed the cost of communicating and coordinating across distances. The internet, mobile phones, and cloud data let firms manage suppliers and customers worldwide in real time. And e-commerce means even a small UK craft business can sell globally through platforms like Amazon and Shopify. When moving information becomes almost free, distance stops being much of a barrier at all. The third driver is a humble steel box, the shipping container. Standardized from the 1960s, it lets goods be packed once and moved seamlessly between ship, train, and lorry. That single innovation slashed the cost and time of transport and cut theft and damage sharply. Combined with cheap air freight, it made sprawling global supply chains both affordable and reliable. The fourth driver is the long retreat of trade barriers since 1945. Through round after round of international negotiation, countries have lowered tariffs and quotas. And in 1995, the World Trade Organization was created to set the rules and settle disputes. Regional deals helped too. The EU single market swept away barriers between neighbours. Lower barriers made trading and investing across borders far cheaper and easier. It's worth pausing on just how much container shipping changed things. Global container traffic has grown enormously since 1980 because the standard box made moving goods cheap, fast, and dependable. That reliability is exactly what long international supply chains need to function. Here in Britain, ports such as Felixstowe and Southampton handle millions of containers every year, quietly keeping the shelves stocked. It helps to see these drivers as a timeline. In the 1960s and 70s, container shipping was standardized, and multinationals began pushing abroad. The 80s and 90s brought financial deregulation, the EU single market, and China opening up to trade. 1995 gave us the WTO and another fall in tariffs, and from the 2000s onwards the internet and e-commerce stitched global markets together in real time. Let's line the four drivers up side by side. Multinational growth spread production and investment worldwide, as Nissan did by investing in Sunderland. Communications let firms coordinate and sell globally, the way UK sellers reach the world through Amazon. Containerization delivered cheap, reliable transport through ports like Felixstowe, and fewer barriers via the WTO and the EU lowered tariffs across the board. Together, they made the modern global economy possible. Picture the docks before the container arrived. Loading a cargo ship by hand could take days and cost a small fortune, with goods often damaged or pilfered along the way. A standard container, by contrast, can be loaded in minutes and craned straight onto a waiting lorry or train. Shipping costs fell so far that it became cheaper to make something on the far side of the world and send it to Britain. And without that humble box, much of modern globalization simply wouldn't exist. Now to the impact on the UK, and here we need to be even-handed. Globalization touches four groups differently: consumers, businesses, employees, and the government. And each one sees both gains and losses. The skill this outcome asks of you isn't to label globalization simply good or bad, but to weigh those impacts from each perspective and reach a balanced judgment. Consumers are among the clearest winners from globalization. Clothing, electronics, and food made abroad cost far less than if they'd been produced only in the UK, and shoppers enjoy a huge range of products and brands from around the world, with competition keeping quality sharp. Just think how affordable a television or a t-shirt has become compared with a generation ago. The catch is that some of those cheap imports come from producers with lower labour and environmental standards. Weighing it up for consumers, the gains are substantial: lower prices, an enormous choice of goods, quick access to the latest technology, and firms kept on their toes by competition. But there are genuine concerns too. Some imports are made under poor working conditions, local products and identity can fade, and our reliance on long supply chains leaves us exposed, as the pandemic showed when shortages hit everything from bicycles to computer chips. For UK businesses, globalization is a double-edged sword. On the upside, they can source materials and components cheaply from around the world, sell into markets of billions of customers, and tap global finance to fund their growth. The flip side is fiercer competition from foreign rivals, which can force firms to cut costs hard or sometimes to close their doors altogether. Dyson, for instance, expanded globally, but also shifted manufacturing to Asia to stay competitive. Jaguar Land Rover is a perfect illustration of a UK business that both gains from and depends on globalization. It sources components from a worldwide supply chain to keep costs down and exports most of its cars, selling heavily in China, America, and Europe, while its Indian owner Tata provides the finance for new models. But that global reach cuts both ways. A downturn in China or a shortage of parts feeds straight through to UK output and jobs. Opportunity and exposure in the very same company. For workers, the picture is more mixed, and this is often the most sensitive part of the whole debate. On one side, inward investment and exporting industries create new jobs. Think of the car and finance sectors. On the other, offshoring, moving production abroad where labour is cheaper, along with cheap imports, has closed UK factories and cost manufacturing jobs. Workers caught on the wrong side may need to retrain and move into new industries, which is difficult and disruptive, and globalisation tends to create winners and losers among workers at the same time. The UK motor industry captures both sides of this story for employees. Inward investment created thousands of jobs, with Nissan in Sunderland and Toyota in Derbyshire. But older British-owned firms have struggled. MG Rover at Longbridge closed in 2005 with heavy losses, and Honda shut its Swindon plant in 2021, moving production abroad and costing around 3,000 jobs. The very same global forces that create jobs in efficient plants can destroy them in ones that fall behind. Britain's trade figures reveal an interesting split. The UK typically runs a deficit in goods, importing more physical products than it exports, but a surplus in services such as finance, insurance, and education. Globalisation has deepened both flows, making Britain a strikingly open economy. That persistent goods deficit, though, is one of the concerns globalisation raises for policymakers. Government has to manage the economy-wide effects of all this. Cheap imports helped keep UK inflation low for years, but leaning on imports means a global shock. In energy, say, feeds straight through to our prices. As households felt sharply after 2022, There's the goods trade deficit to worry about, and multinationals that bring welcome investment and tax, but can also shift profits abroad to avoid it. So government reaches for trade policy, regulation and investment incentives to capture the benefits while managing the costs. Let's set the UK's benefits and costs against each other. On the benefit side, cheaper goods and years of lower inflation, inward investment, jobs and tax from multinationals, huge export markets, especially in services, and access to global finance and talent. On the cost side, job losses from offshoring and import competition, a stubborn deficit in traded goods, exposure to global financial and supply shocks, and downward pressure on wages in some low-skill sectors. A real economy always carries both columns at once. So what's the verdict? On balance, globalisation has brought the UK large benefits: cheaper goods, fresh investment, jobs in new industries and vast export markets, particularly in services. But those gains and losses are spread unevenly, and some regions and workers, especially in the old manufacturing heartlands, have clearly lost out. The real policy challenge is to share the benefits more fairly and support those who lose from change through skills, regional investment, and help to retrain. Overall, it's been a net gain for the UK, but managing its costs is very much unfinished business. To pull it all together, globalisation has been driven over the last 50 years by the growth of multinationals, by technology and communications, by containerisation, and by the fall of trade barriers led by the WTO, all reinforcing one another. UK consumers have gained cheaper goods and wider choice, while businesses gained access to materials, markets and finance, but face tougher competition. Employees have seen both new jobs from inward investment and losses from offshoring, as the car industry shows so vividly, and government must juggle the effects on inflation, trade, jobs and tax. Overall, a net gain for the UK, but with costs that fall unevenly. That wraps up our second learning outcome, where we've traced the forces behind globalisation and weighed its uneven impact on UK consumers, businesses, workers and government. If you'd like to explore further, the reading list offers a strong foundation, with Stiglitz for a critical view and Sloman and Anderton for the core economics. The World Trade Organization's reports and the Office for National Statistics are ideal for up-to-date trade data. And the case studies on the UK car industry and on Tata and Jaguar Land Rover are especially useful for building your arguments. Spend some time with these, and you'll be well prepared to reach the balanced judgment the assignment is looking for.